Chris, so good to see you. We are getting back to basics today with RMD 101, the rules that catch retirees off guard. Required minimum distributions aren't just about taking money out. They come with specific IRS rules that affect how, when, and where those dollars can be used. Understanding the basics can help you avoid penalties, manage taxes, and even support your favorite charity. So let's start with number one here. Each account is separate. The IRS requires you to calculate the RMD from each of your pre-tax retirement accounts individually. How does this rule catch people off guard?
Yeah, it does catch people off guard. So, it's very common that retirees today may have 2 or 3 IRAs. They may have one at the bank, one in a brokerage account. Perhaps they have an annuity at an insurance company. And if they all are titled as IRAs, they can aggregate the distribution and take it out of just one of them, or out of 2, or out of all 3. And then if they are married, their spouses obviously will have their own IRAs to worry about as well. If somebody has a 401k and an IRA, 2 different types of retirement accounts, 2 different types of distributions. So it can be a little confusing, especially the first year. Once you get by the first year, it gets a little easier.
Right. All right. Number 2, you cannot use your RMDs to directly contribute to a Roth IRA. Why is that?
Yep, because contributions to a Roth IRA have to come from earnings, so wages, for example. Okay. Now, you can obviously do a Roth conversion. So I always use the mantra, not everybody can contribute to a Roth IRA, but anybody can convert to a Roth IRA.
Okay. Now, on the other hand, though, using an RMD for other expenses is okay. Once the RMD is taken, the cash is yours to use however you wish. Does that include reinvesting in a taxable account?
Yeah, absolutely, Erin. We help a lot of our clients that don't need the income, and we just move the money from, say, a stock investment in the IRA to a stock investment that's not in their IRA, like a taxable brokerage account. Do that often.
Okay. Number 4, this one's my favorite, Chris. You can use your RMDs for charitable donations. How does this work?
Yeah, we do a lot of this for our clients. It's called a qualified charitable distribution. And this starts at age 70 and a half, Erin. So as they raise required minimum distributions to 73, they kept the qualified charitable distributions at 70 and a half, which is fantastic because many people that are older are obviously very charitable. So the check goes from your IRA directly to the qualified charity, so a nonprofit. Your kids and grandkids are not qualified charities. We make that analogy too for our clients, but we do a lot of that. And what that can do for somebody that's 73, and let's say their required minimum distribution is $10,000, they can pay some or all of that directly to 1 or 2 different charities, or 3 even.
Yeah, it's so powerful. The way I explain it is like if you're putting money in the collection plate, there's probably a more tax efficient way to do it. It's such a great strategy, Chris.
Yes.
All right. And then number 5, it bears repeating, even if people know this, RMDs are taxable.
Yes, they certainly are. And they are taxed at the tax bracket that you're in. So, for most retirees that are watching this video, we're probably talking that you go through the 10% bracket, you hit the 12% bracket, and then 22%. And that covers probably, there you go, covers the bulk of the retirees today. And, obviously, if somebody buys a condominium or something, they may go into the 24% tax bracket. And that can have some other implications, like how much are your Social Security's taxable, how much are your Medicare premiums. So, we help guide people through this process on how much is too much when it comes to IRA distributions.
Right. And it all comes back to proactive planning, Chris. And you wanted to bring up how Roth conversions can help offset those RMD taxes.
Yeah. And, you really get a lot of opportunity right now. Tax rates are at historical lows. Right. We had the one big beautiful bill last year that got passed that helps people. And so, we do a lot of Roth conversions, typically later in the year when people know how much income they've pulled out of their IRA accounts and how much more they need to get, through the end of the year. But, that money will be tax-free to beneficiaries and tax-free, obviously, to the Roth owners eventually if they need it as well. And that can, if you're 65 years old when you retire, you can start doing some Roth conversions in bits and pieces, and then you lower those required distributions that can catch you later on in your retirement.
Absolutely. Yeah, no, sometimes people really aren't planning on how those RMDs can throw off their taxable income in retirement. So as you mentioned, it all comes down to proactive planning. If somebody would like to sit down with you and learn how to better manage their tax burden in retirement, what's the best way to reach you?
Yeah, I'd have them call Heidi at the office there at 419-332-0532. We have offices in Perrysburg, Fremont, Port Clinton. The main office is out of Fremont, 419-332-0532, and McIntireRetirementServices.com as well.
Great. Chris, thank you.
My pleasure, Erin. Thank you.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntyre. Be sure to subscribe.